Reliance results, growth engines in action. Reliance Industries recently announced its results and social media has been buzzing about how the company beat analyst estimates. The highlights: revenue grew by 8%, EBITDA by nearly 8%, and profit after tax but surged by approximately 12%. Source: RILS earnings presentation. Essentially, it performed better than expected, which is one reason being cited for the stock climbing more than 2.65% in a day. While stock price movements and analyst predictions aren't our focus, the business results of India's largest company, by any metric, deserve a closer look. And that's exactly what we'll be doing today. Reliance is a sprawling conglomerate with operations spanning multiple industries, but its results are reported across 4 key business segments. I'll walk you through the highlights of each segment, sequenced by their contribution to future profits, from biggest to smallest: digital services, retail, oil to chemicals, O2C, and finally, exploration and production, E&P. To set the stage, out of the additional 3,500 crore rupees in operating profit Reliance made this quarter compared to the same period last year, a massive 68% came from digital services, followed by 17% from the retail business. Source: RILS earnings presentation. And it's not just about the current numbers. According to Motilal Oswal, nearly all the incremental operating profit over the next 4 years, FY24 to FY27, is expected to come from these two segments. Digital services and retail represent the company's growth engines, while the oil businesses O2C and E&P are in their maturity phase, providing stable cash flows. Source: Motilal Oswal. Digital services. Jio remains the world's leading standalone 5G operator outside China with a subscriber base of 17 crore. 5G now accounts for 40% of wireless traffic during the quarter. Jio network continues to attract 70% of the incremental 5G devices sold in India. The big story: price hikes are finally working their magic. Back in July 2024, Jio raised its tariffs. And now, the impact is starting to show. ARPU, or average revenue per user, has been climbing for 2 straight quarters after being flat for a while. This is a big win for Jio because ARPU is a key measure of how much money they're making from each user. But let's not forget, it caused some churn. Over a crore subscribers left last quarter, with many heading to competitors like BSNL. But now things are stabilizing. In Q3 25, they managed to add back 33 lakh subscribers, bouncing back after the previous quarter's dip. That's a clear sign that the SIM consolidation phase, people dumping extra SIMs due to higher prices, is behind them. Jio says the full impact of the tariff hike is still to come. Translation: ARPU could keep climbing. Plus, some analysts are already predicting another tariff hike in FY26, which could further boost revenue. So, on the ARPU front, things are looking pretty solid. But it's not all smooth sailing on Jio's capital expenditure. It's still high, and their free cash flow, or FCF, isn't exactly robust. That's a bit of a red flag. The good news: CapEx seems to be slowing. In the first half of FY25, it's come down compared to the spending frenzy of FY24. Analysts, like those at Motilal Oswal, are even calling this the peak of Jio's CapEx cycle. They believe Jio's spending will taper off as the major 5G and fiber optic (FTTH) rollout winds down. Source: Motilal Oswal. That said, any CapEx savings from Jio will likely be offset by Reliance's new energy investments, think solar, hydrogen, and battery projects. But the takeaway here is clear: the heaviest spending for Jio might be behind them, giving them room to improve their cash flows. So, to sum it up, Jio's ARPU is climbing, customers are coming back, and while CapEx remains a challenge, there are signs that it's easing up. All eyes are now on how Jio capitalizes on these trends and continues its journey as a key growth driver for Reliance. Retail. Let's dive into Reliance's retail business, which finally saw revenue growth after struggling with slowing growth and even degrowth last quarter. Revenue grew by 8.8% year in Q3 25, reaching 90,333 crore rupees. So, what changed? Reliance attributes this turnaround to productivity improvements and store rationalization. Source: Motilal Oswal. Productivity improvement means they've been doing more with less, streamlining operations, optimizing store layouts, and improving customer engagement. Store rationalization involves closing underperforming stores while focusing on profitable locations. This approach might seem counterintuitive for a growth-driven retail chain, but it's a smart move for long-term efficiency. They opened 779 new stores, taking the total count to 19,102, but have been seeing their retail area decrease since the start of the financial year. Source: Motilal Oswal. Reliance Retail operates across categories: electronics, apparel, grocery, and more. While it doesn't represent the entire Indian consumption market, its performance gives us valuable hints about broader consumption trends. If Reliance Retail is bouncing back, it might mean consumer sentiment is improving, and spending may be picking up, especially in categories like grocery and apparel. What really stands out in their retail portfolio is Camper Cola, Reliance's homegrown brand that has become a key part of their grocery strategy. Acquired in 2022 for just 22 crore rupees, the brand has already captured over 10% market share in the sparkling beverage category in select states and is on track to cross 1000 crore rupees in revenue by FY25. Exploration or production E&P. Reliance's exploration and production E&P business had a stable quarter, continuing to deliver consistent results. Production from the KG-D6 basin remained steady at 28 million standard cubic meters MMSCMD, with gas price realization slightly improving to $9.74 per MM2 compared to $9.66 last year. Source: Motilal Oswal. While the segment doesn't contribute a large share of overall revenue, it plays a vital role in supporting Reliance's downstream operations by providing essential raw materials like natural gas and crude oil. However, margins in the E&P segment depend heavily on global crude oil and gas prices, which have been volatile. Despite this, the segment saw a 5% quarter-on-quarter growth in EBITDA to 5,570 crore rupees, although it was down 4% year-on-year. On the investment front, capex in E&P remained moderate as the company focuses on maintaining production rather than aggressive expansion. Looking ahead, Reliance might further cut E&P investments as it shifts its focus toward its new energy projects. Oil-to-chemicals (O2C). The oil-to-chemicals (O2C) business, Reliance's largest revenue generator, performed well in the third quarter, showcasing its resilience. Revenue grew by 2.4% year-on-year and 16% quarter-on-quarter, driven by stronger refining margins and higher crude processing volumes. Reliance processed a record 17.9 million metric tons (MM) of crude, which is a 9.1% increase from last year thanks to strong domestic demand. It was great to see the demand for transportation fuels growing by 17% year-on-year. Higher demand for transportation fuels is typically linked to increased economic activity. This is another sign of relief we see from Reliance's result. Source: RILS earnings presentation. Source: Motilal Oswal. That said, margins were a mixed bag. The EBITDA per ton declined by 7.5% year-on-year to $95 due to weaker margins in the petrochemical and polyester segments. However, compared to the previous quarter, margins saw a 14% improvement, supported by better refining cracks for products like gas oil and jet fuel. Reliance has been investing heavily in modernizing its O2C operations, focusing on efficiency and sustainability. While capex in the segment remains high, there are signs that it is starting to moderate. Importantly, a portion of the investment is now being directed toward green energy initiatives, such as carbon capture and hydrogen production, as Reliance prepares for a low-carbon future. Reliance's results don't pack any big surprises, but they do reaffirm the narrative. Digital services and retail are living up to their roles as the key growth drivers, while the legacy oil business continues to hold its ground with steady performance. If there's a segment where we might see more excitement, it's Reliance's new energy ventures, where they've committed a massive $10 billion investment. However, this is a long gestation business, and looking at it through a quarterly lens doesn't fully capture the progress or potential here. For now, digital and retail remain the stars of the show.